This is Troy Davis. This is the Money Matters program, and today we're going to talk about small and medium-sized businesses. If you own a business, if you are thinking about starting a business, if you've got a small or medium-sized business that's having some issues right now, and we know certainly with the economy and the recovery, we've got a lot of that going on. So today we're going to talk about business restructuring, and we're going to be talking about the stock market. We're going to be talking about the real estate market and how all these things kind of come together and affect small and to medium-sized businesses. On the phone with me today, I have David Sussman. David is the founder and CEO of Valcor, of ValcorWorldwide.com, and he's also the founder of International Association of Business Mediation Consultants. He's a small business advocate who specializes in small business restructuring, debt mediation, and capital acquisition services. And David was actually born and raised in London, England, and he's got a master's in business and organizational management, and he has a bachelor's degree in psychology. And David has been published in articles and has been featured on the Washington Post, Fox Business Channel, the LA Times, CNN, and many others. David, welcome to the Money Matters program.
Thank you, Troy. Thanks for having me.
You're very welcome. I'm glad you're here. I certainly have been an extreme advocate and proponent of small to medium-sized businesses as being the way out of this difficult economy. I think you would agree with that.
Absolutely. Absolutely. It's small business that really generates the growth in this country. Free enterprise allows small businesses to hire employees, give people jobs, and I think there's a statistic that says about 90% of all employed people in the United States are employed through small, medium-sized businesses, not the large corporations.
Yeah, and if you really stand back and hear that stat, that is just really unbelievable. About 90% of the workforce. And how do you define small to medium-sized businesses, David?
Well, SMB, small medium businesses, probably do upwards of up to about $100 million a year in gross revenues. In many cases, they have anywhere from 1 to 2 employees up to several hundred, in some cases 1,000. Our marketplace really starts to laser in on the smaller businesses, the companies that are doing up to about $50 million a year in gross revenues. And when we're talking about that particular demographic, you're still talking about roughly 60% of the economy that is based upon those small, medium businesses that will hire 30 people, 50 people, 100 people. Not huge businesses that you don't know about. They're certainly not public. They're not in any stock market. And they're just local businesses.
Yeah, and it seems as I read the media, look at the media, it seems like a lot of these big blue chip companies are doing pretty darn well. I mean, we're seeing record profits from a lot of these companies, and we're thinking, well, geez, we must be rolling right along, but it's really not those companies that we're focusing on today. It's the small to medium businesses that really are the coal to the steam engine, if you will, that we want to refer to today. David, give me a little bit of an idea of your background and how long you've been working with other businesses to help them get back up on their feet.
Well, originally I was in the field of psychology. As you mentioned, my undergrad, and I was a PhD candidate. I was moving towards the clinical psychology as a career. There was a somewhat of a, well, how to put it, I became disillusioned. And I was fortunate because I was raised by my late father, who was an entrepreneur's entrepreneur. He started 30 businesses in his life. 3 of them were successful enough for them to raise him to raise 4 children. We emigrated to the United States in the 1970s. And I sat on the front lines and watched him. And I realized that I probably had a master's degree in business before I graduated high school, just because of assimilation, sitting there watching him struggle and deal with vendors and deal with employees and deal with regulations and taxes and everything else that was going on. And so I had somewhat of a shift change, and I decided I wanted to take a break. I was introduced to a friend of mine who was working at one of the hospitals as a CFO. They got in a lot of trouble. If you remember, there was a tremendous amount of consolidation in the medical field. And this hospital, one of the hospitals I was working at in the psychiatric field, was in trouble. They were probably going to be going bankrupt. And I started speaking with him and asking him questions about what was going on with the hospital. I started asking him what I thought was common sense questions, regarding debt and equity and issues like this. And he looked at me sideways, like a dog would look at you funny. And he says, "You're a psychologist." And I said, "Yeah." And he says, "You're asking me questions I can't answer. I'm a Wharton School business grad. And I don't, come into my office at 3 o'clock today. Let's talk about this." And that meeting basically turned into a consulting gig, which at that point in my life, I was seriously reconsidering my career in psychology anyway. I decided to take some time, and through the medical field, I found clients. And within a few years of that, Valcor was born. We decided to expand in the early 1990s by providing training for licensees to set up independent offices throughout North America and London, England. And we now have over, 20 years later, we now have over 100 licensee offices throughout North America, and we're doing business with small cases, small businesses on a regular basis, and it's very rewarding. We go into small businesses today. We provide them the resources to enable them to get through their short cash flow situations, restructure their debt, prevent litigation from ensuing, and bring in capital. And cash flow is, as you know, Troy, it's the lifeblood of a business.
Yeah, it really is. So and it's interesting how
that's where we are today.
It's interesting how you kind of come across something in your life that becomes your lifeblood in your business. It sounds like that's what occurred here, and done it very successfully, which is fantastic. And I'd imagine you have seen in your tenure of helping businesses kind of get back on their feet a really dynamic shift in the last few years based on where our economy is and the incredible financing crunch that is out there. And I know it's for not just for homes, which is what I do in real estate, but for businesses as well. And we'll get into that in depth more. We'll talk about different alternatives to financing for small business and what's good about those, what's bad about those. And I also want to talk about, we'll use that bubble word, and we'll talk a little bit about what you see coming up on the horizon as we move forward. And I imagine, David, today's small business owners are dealing with just a whole host of problems right now. I mean, you've got cash flow issues, which you talked about, which you mentioned they lead to litigation or bankruptcy or even closing this business that is their baby. And I imagine these business owners are extremely stressed out. So where do you start? Do most of these businesses come to you saying we just have a cash flow issue and we can't get funds? Is that kind of like the bottom common denominator?
Well, it's a good question. What is the genesis of a business that gets into trouble? How do they get into trouble? Mm-hmm. There's a myriad of ways. I always say to our licensee, I do a lot of training and speaking engagements, and one of the things I always mention is that every business is different. It's like a business is like a fingerprint. There's not one business that's the same as another business, and the reason is because obviously it isn't just the industry or the product or the service that they're providing, but it's the number of employees. It's the politics within the employees. Are they family members? Are there friends involved? How long have they been in business? So once you start to take a look at the individual business itself and understand what it is that you do, I would say that the common denominator that we're seeing today in 2013, we've really seen this now for the past few years, probably since 2009, is that cash flow, which we just discussed is the lifeblood of a business, for many businesses has come to a standstill. It is slowed down tremendously. And if you have bills to pay, you have payroll to meet, you have taxes, you have insurance, you have needs for working capital for expansion, and your clients aren't paying you in a timely manner, where do you go? What do you do? So a lot of businesses are used to having lines of credit with banks, and they'll tap those lines of credit to make ends meet, to bridge themselves until they get paid, if you will. Mm-hmm. But unfortunately, in the past several years, many of those bank lines of credit have been either reduced or they've been basically completely withdrawn. We've had clients all over the United States with small, medium, and large national banks who have all been crying to us, literally crying to us, saying, I had a $50,000, $100,000, $200,000 line of credit. I needed that line of credit to pay my bills, to buy product. I don't get paid until I actually fulfill the order. Well, I need to buy product to fulfill that order, and I use my line of credit. And now Bank of America or American Express or whoever it may have been has reduced my line of credit.
Well, that's what I was going to ask, David.
Wiped it out.
These line of credits, it's not necessarily that these businesses are maxing them out. It's the banks made a conscious decision to either zero them out or reduce them dramatically, correct?
Correct.
So, and that's just arbitrary. They may have great credit history with this bank. They may have, paid their bills on time and done their thing, but the banks are so concerned about their bottom line and the assets that they have being out there that are maybe not secured properly, or, this big bailout that they got, and they're saying, well, we need to be careful now, so let's just shut this down. And what they're not realizing, it doesn't seem to me, is that they're shutting down business. They're shutting down America that way.
That's the net effect. You're absolutely right, Troy.
And on top of that, I'll go a step further, and that is, and again, I'm relating it to my business a little bit, David, and that is, real estate here in Orange County, is that I'm seeing this daily with my clients. I mean, perfectly good, qualified borrowers are just simply not able to get their loans. I know there's some softening of that right now, even coming from the White House. They're starting to say, hey, let's let borrowers a little bit more leniency on their criteria for getting a loan, which I personally think is good. I'm not saying go back to 125% financing, which just didn't work out at all. But you have to loosen it up somewhat. And then on top of that, it just seems that what are you going to do? These banks are so big. They've got all the law firms on their sides, the collection agencies, the bank. They're all loaded up against you. Then you get this business owner going, where do I go? And they go to a place like Valcor, I would assume, to say, what can we do from there?
Well, you're correct, and I think like the Dodd-Frank bill and the healthcare bill, we have to see what the bill is once they pass it. Regarding,
and it's a big one.
Allowing banks, or in some cases forcing banks to be a lot more lenient on business loans or commercial loans or residential loans, whatever the situation may be. I'm not too sure at what level they're going to get to. I don't think it will be a good thing for this country in the long run if they start doing these subprime type loans again.
I absolutely agree.
I really don't. Look, we had a bubble. It was an artificial bubble that was created by government policy. I call it the perfect storm. Mm-hmm. With the repeal of Glass-Steagall in the late 1990s, with the low interest rates that occurred because Alan Greenspan did what he needed to do to basically give the world confidence that America was still in business after 2001, and with Congress basically dictating that everybody should have a home in the early 2000s, through the Community Reinvestment Act and so on, it led to, in Wall Street, investing in mortgage instruments, which led to the biggest bubble in American history in real estate in the shortest period of time. And we went from the levels of Mount Everest as far as property valuations down to the Mariana Sea Trench.
Oh boy, you're speaking to the choir now.
Slowly coming back here, but the fact of the matter is that was all dictated by policy. What the government dictates, what they stipulate as far as policy, it has an effect and a direct impact on the economy, especially small businesses.
And it seems, these are seemingly, and I'm going to give them some credit, a lot of intelligent people in Washington. I say that with slight tongue-in-cheek. I don't know a lot of them personally. But you would think that...
Oxymoron, isn't it?
I don't know. You would think that they would see the light. They would understand exactly what you just said in about 5 sentences and say, we're killing it here. We're just killing everybody with, and we'll get into some of the sequestration and the debt ceiling in a moment, but I just can't imagine they can't look at this and look across the aisle, this bipartisan situation, and say, look, here's what makes sense. Let's lend to small business. Let's get them up and running. Yes, we'll look at them with a critical eye, but at least allow the funds to be there, because I know the funds are there. It's not that they don't have them. It's they're deciding not to lend it. Do you see that?
Well, you're going to be surprised because I sound somewhat anti-government, anti-Washington in my, feelings here. I'm going to say something that may sound surprising to you. I actually supported the Jobs Act in 2011 that was signed by the President and pushed through Congress. The reason that I supported the Jobs Act was because there was a very specific element of that act which allowed the SBA to fund small businesses. They put $30 billion with a B into the SBA to fund small businesses. And I applauded that, as most other small business advocates did. The problem is that a lot of people don't realize this. The SBA doesn't lend money to small businesses. The banks act as intermediaries and will lend their own money. So if you go to XYZ Bank that has an SBA desk and you say, I want an SBA loan, it is XYZ Bank's money that's guaranteed up to, at the time it was 90, now it's down to 80%, by the SBA. So XYZ Bank will lend me $100,000. If I default on that loan, the SBA will give XYZ Bank now $80,000 back. So they're only on the hook for 20%. Mm-hmm. Well, here's the problem. The banks, which in 2007, 2008, were essentially bailed out, because if they weren't, we were going to have a currency crisis and cash would have just stopped and we wouldn't have been able to buy food at the supermarkets. That's how close we were in 2008, and that's what TARP was. But the problem was that TARP required these banks to combine, to join together. And so you had Wells Fargo and Wachovia and Bank of America and Countrywide and so on. And so now these banks, which in 2008 were too big to fail, in 2013 are now too big to save. And they're sitting on trillions of dollars in cash because of quantitative easing. The Federal Reserve is pumping money. They're basically printing money, their own printing press, and spending money on financial securities and instruments from the largest firms, the investment banks and the Wall Street firms. And these firms are sitting on this cash because they're looking at, hey, look, the indicators in the economy right now is that we've got slow growth. But we're worried about this, we're worried about this, we're worried about that. And so we don't want to be caught like we were in 2008, and because in 2008 we were too big to fail, the government had to step in. In 2013, 2014, 2015, we're too big to save. And so I think what the banks are doing right now is where the pendulum from 2002 to 2008 with real estate loans and commercial loans, the pendulum was all the way an extreme in one end. The banks have now swung the pendulum all the way back to another extreme where they're no longer lending at all.
Exactly.
It was not the government that didn't want. So out of that $30 billion, by the way, Troy, only $4.3 billion actually got lent out.
Exactly. Yep. It's a travesty. I mean, I'm looking at it too. Like you said, Wall Street's sitting on these huge amounts of cash. You know, your hedge funds, these investor groups, and I know they're certainly in the real estate business, and we'll talk about that in just a little bit. But you know, they're just buying stuff out cash because they're saying, well, look, okay, we've already profited 1, 2, 3 times after the loan was taken out on real estate, after it was securitized, sold off, secondary market. Okay, there's our third profit. Foreclosures, you know, it just goes on and on and on. And now all of a sudden, we've got all this cash back again. Let's do something with that. We could go on and on probably just on that topic alone. But let's talk a little bit about an article that you recently had published in the Washington Post. The title of that was Small Business Lending Growth Scare: Which Loan Alternative is Right for Your Company? And we all, as we know, again, the credit crisis really just shut the doors on small business with this. And you mentioned something in an article that I had no clue it was even that bad, and that is 9 out of 10 loan applications are typically rejected. Is that correct?
Well, they are, and these are statistics that we've gathered through multiple resources here. We do a lot of business with banks. We work with banks very closely. And so, you know, I'm going to be on a panel in the next couple of weeks for SBA score on alternative lending as well. And the panel I'm going to be sitting on with people from the SBA and Wells Fargo and so on. So I'm very in tune to what's actually going on with the banks. But the reality is that it goes back to the last comment that we just discussed, the last subject, and that is the banks are not lending. They just simply aren't lending. Now, if you've got 800 credit score and you haven't had a blemish on your credit report since 1977, and you've got receivables, and you've got assets to borrow against, and you've got this, and you've got that, then the banks will seriously consider, and they do make loans because some people that are in that category. But the reality is that most people that are looking for business loans today, commercial loans, are not in that perfect scenario. In many cases, they need cash flow to improve their business, need working capital. And the bank will look at it and say, well, without this working capital, you don't have the cash flow necessary to service this debt. And it's chicken and egg.
I was going to say it's a classic catch-22.
It's the catch-22, chicken and egg. And so, when you're dealing with a bank today that is looking for a reason not to lend, they're looking for a reason. Look, we're dealing with multiple alternative lending sources, and even the alternative lending sources are underwriting at a level which I've never seen before. I mean, the due diligence is insane. And basic loans, we've got one situation right now with a client that it has a fully paid off piece of property. It's appraised at more than the value of the loan that is being requested, a line of credit against it, and they're doing the due diligence on them and underwriting and using every conceivable document possible, whether it's tax returns and cash flow statements and this and that, going back years and years, and this is a fully collateralized loan.
And they're probably looking for a reason not to lend. Why else would you want that much documentation? Yeah.
And so the banks are scared. They're squeamish right now.
And you had mentioned the Troubled Asset Relief Program, TARP. That kind of came in and changed a lot of changed the game, basically. And also you mentioned in that article that a lot of the bigger companies are actually taking longer to pay the receivables. How's that working?
Well, Wall Street Journal reported this, and it was basically you're looking at an increase in the receivables time. So if you're normally a 30-day pay, you get a bill and you pay within 30 days. On average right now, according to Wall Street Journal, that has increased to about 46, 47 days. So if you're relying on that, and that's the average. There's obviously people that are much longer than that and slower than that. But if you're relying on that cash flow to meet your obligations and your bills, and somebody that was supposed to pay you 3-4 weeks ago hasn't paid you yet, and you've sent them collection letter 3 and collection letter 4, they say we are paying you, but it will be in next week's mail.
Yeah.
And meanwhile, you've got your own bills to pay. That's slowing down your cash flow.
Yeah, and those guys aren't wanting to.
A lot of the litigation today between companies.
And they're not wanting to wait the 45 days. So I've got a real life example of that. My wife, one of her clients, is an international business, and they now pay in 60 days. And she's like, really? I'm like, what's that? So I'm asking her, so why are they doing that? She says, well, they have the right to, I guess. They can. So yeah, she went 60 because they can, yeah.
But it's also because it's a domino effect, and chances are that they've got clients of theirs that are doing exactly the same thing.
Yeah. I'm going to actually read a quote from that article that you wrote. Quote, small businesses are the engine that drive our economy. They employ all of our private sector employees, generate 65% of all new jobs in the country, and pay 44% of the nation's private payroll, according to the U.S. Small Business Administration. But without sufficient financing or liquidity, these smaller companies can't expand their operations, invest in new equipment, or fund new research and development. Often, they can't hire new employees, and in many cases, have to lay off existing staff. So let's talk about what Valcor does in your instances when we're talking about alternative financing. Give us some ideas. Well, actually, you listed about 7 different ways here. What I'll do is I'll read down those alternative financing for businesses, and you give me the good, the bad, and the ugly of each, okay?
Sure.
The first one is using credit unions, and we talked about SBA loans. What's the deal with those right now?
Well, it goes back to what I was just saying to you before. The Small Business Administration doesn't lend the money. It's actually the banks that lend the money.
Right.
And there's 2 different kinds of SBA loans that are available today, both of which are named after the congressional bills that passed those acts. And one is called the 7A, which is typically the Small Business Administration's loan that you think of when you're thinking of a small business loan. There's multiple reasons why you can apply for a 7A loan. And those reasons go across from having working capital to consolidate your debt, to purchase equipment, property, and so on. And then the second loan is actually 3 loans, but the second loan, the 504, is to purchase the property that your business currently exists in. And typically those are fairly, relative to getting a mortgage, they're a little bit more cost effective than getting a standard mortgage. They are, some people will say they're easier to get. I don't see that today because, again, it's the banks that are funding this, not the SBA, but there may be some more advantageous terms. There's a third type, which is very little known. It's called microloans, and these are very small business loans. These are geared towards empowerment zones, geographically speaking. So if you're in a certain zip code, you may be able to apply for these micro loans, which go up to $50,000. I think they're averaging right now about $13,000 for these micro loans. Those are pretty good for small startup situations. But again, it depends upon where you're located.
And David, are you seeing the trend continue from what I was seeing a couple of years ago, where businesses are really trying to buy the buildings that they're in?
We are seeing a little bit of that now, starting to percolate again. Obviously, the thing about, and you know this better than anybody, commercial real estate terms are not your typical 30-year fixed mortgage that you get when you buy a primary residence. They're 5, 7, 10, 15-year terms. So a lot of people that bought in the last decade are still upside down. Because if you bought in 2005, 2006, and you've now got a 10-year term that's coming due, let's say in the next couple of years, or a 7-year term and it's coming due this year, there's a very strong likelihood you're still underwater.
Okay.
So that's one of the biggest issues that a lot of property owners are facing in the commercial real estate game right now.
And then a second type of alternative financing is asset-based lending. Talk to me about that.
Yeah, I mean, this really covers a huge spectrum of different financial instruments, and we're doing a lot of these today. One of the things that we focus on with our clients is, what do their assets look like? Do they have equipment? Do they have payables that are due to them? For example, contracts and orders or receivables. Do they have a property that they're based in? Do they have fleets of cars and trucks and cherry pickers, whatever it may be? The list goes on and on. If you have an asset, and asset-based lending, referred to as ABL, if you have an asset that could actually be leveraged, there's a lot of different alternative lending sources that are out there that will leverage that asset based upon the value of it. In some cases, it's a liquidated value. But what it does is it provides a very quick and easy resource for cash flow. And that's for many businesses, again, as we go back to before, the lifeblood. So if I've got somebody that owes me $200,000 and I haven't collected it yet, they haven't paid me yet, I may be able to factor that $200,000 and maybe 80% of it up front. And, there's other sources as well there, types of lending, but what it does is it allows us to put cash right into the business.
And does that asset necessarily need to be with the business? Could it be a private residence?
In some cases, we do mostly business loans, but it may be collateralized by a primary residence if the equity is there.
And you listen to the Money Matters program on KOCI 101.5, and we are speaking with David Sussman, who is the founder and CEO of Valcor, which is valcorworldwide.com, a business restructuring and getting folks back up on their feet with small and medium-sized businesses. We are talking right now about alternative financing for businesses because it is so tight with the banks right now. And the third one you have here, David, is factoring. What is factoring?
Well, it goes back to what we were just talking about. It's an asset-based lending. It's accounts receivable that basically what the company is doing is they're borrowing against future income that they're expecting. And it's usually with good blue-chip companies. You can't show, a receipt from your brother-in-law, Mike, and say, hey, look, he owes me $100,000. Can I borrow against it? It has to be, obviously, a legitimate company.
Right.
But that provides a very quick resource of monies to any company that is owed money.
And the fourth one is business line of credit. We talked about that pretty much already. I mean, we know that those have been reduced or zeroed out in a lot of companies. So the availability of business lines of credit, and as you mentioned, David, unless you've got an 800 FICO and you've been perfect since 77, that might be tough to get a new one.
Well, there is something else I'd like to touch upon, business lines of credit. Mm-hmm. Business lines of credit is not typically referred to as the same as bank lines of credit. Let me explain the difference. And what we're looking at here is a relatively new instrument which is being provided by specialist finance companies which allow individuals that are looking for anywhere between, and this is usually for smaller loans, anywhere between $30,000 and let's say $300,000 to raise money. And this is going to be based upon their personal credit score. It doesn't have to be based upon a business that exists, or it doesn't have to be based upon any collateral or assets. So a business line of credit, which is what I think you're reading from the Washington Post article I wrote,
yes.
That's what this refers to specifically. Now, you cannot get a business line of credit if you have less than a 680 credit score, preferably 700 or higher. And, once you have this, basically there are multiple resources that we can access through the banks, but not through the front door through a standard business loan or a line of credit from the bank, but through the back door. And there's special ways that we deal with this. It can be, allowing a small business owner or somebody that's even looking to start up a small business, a quick resource of capital within 30 days that can allow them to invest into that business, allow them to expand their business or start a business, buy equipment, whatever it may be.
And then you've also got private equity. Are they still looking at taking a big piece of the company when you engage private equity firms?
Typically, we're seeing 35 to 40% is the norm right now. It's very, very tough. And, I mean, we talk about doing due diligence. Boy, I mean, there's I'm not going to say this on the radio show, but there's an old phrase that police use when they're doing a search, and that's what the equity firms do as well.
Got it.
I made the similarity in that article to a very popular TV show called Shark Tank, which I know a lot of people watch. I enjoy it myself. And it's very similar to that. It's a group of investors or an investment bank. They're looking at the valuation of the company. They're looking at a product or service that the company is doing. Do they want to invest into that company? Now, one of the big issues that we're facing when we're dealing with equity, whether it's VCs or angels or whoever it may be, equity groups, joint venture groups, the problem is that does that group want to put their own management structure into the existing company? And once you start dealing with that, at the beginning of our conversation, I talked about the fact that every company is different as like a fingerprint. A lot of companies are run by people who have brought in family or friends. And so if, let's say, a venture capitalist firm comes in and says, I love the product that you guys are selling here. I think you guys have the opportunity to become the next Xerox or whatever it may be. We're going to invest X dollars into your business, but your brother-in-law Mike has got to go.
Yeah, Uncle Frank is not going to cut it.
Right?
Yeah.
He's not the CFO we want. I want to put in my guy. And that's where politics, and I'm referring politics to family politics, starts getting involved. Well, as a business owner, this is my baby. I started this business 5-10 years ago. And now I've got somebody coming in and telling me how to run my business and replacing the people that I believe are best in the business, and it's going to cause me problems and consternation at Thanksgiving dinner. That's an issue.
And is that something you do as a company, is help these businesses look at those offers and suggest ideas for that?
Yeah, we will bring, no matter the source of the financing, whether it's equity or whether it's ABL or, whatever the issue may be, commercial real estate loans, we will bring in the right parties. And, our goal is to filter through. We have access to over 300 categorized lenders. And so it's really about trying to match up our client with the particular lender so that all sides can be happy.
Okay. And we've also heard about mezzanine financing. I'm not as familiar with that. Tell me a little bit about that.
Mezzanine financing is, we talked about subprime real estate loans earlier in the discussion. Mezzanine financing is the equivalent of that. It's a secondary loan. Imagine, if you will, that you're looking to raise $1 million and on a piece of property for $1 million. Let's say you've put in $100,000. So your total is going to be $90,000. You might raise 65% loan to value from a lender. So now you have $650,000. So you've got $750,000, but you still need the remaining $250,000. It's like getting a second mortgage to buy a house. It's going to be a higher interest. It's going to be a different term, and it may be with another lender. And there are specialist mezzanine financing companies that also do bridge loans, and they also do different types of loans which can be construed as higher interest loans, if you will.
Yeah.
I wouldn't call them subprime, but they're just, harder to place loans.
Well, and speaking of the word hard, I think the last place businesses want to go is hard money loans. We're familiar with those in the real estate business, obviously. If you know you've got the capability of repaying and you can get rid of a hard money loan as soon as possible, it's all right. But those are typically very difficult terms, very high interest rates. And I imagine when you're talking to companies, that's a last resort.
You know what, Troy? Three years ago, maybe 2 years ago, I would have agreed with you 100%. Mm-hmm. In today's credit situation, a lot of the hard money lenders are now actually becoming a lot more competitive.
Interesting.
And we're seeing hard money loans where we used to see them upwards of 20%, which is insane. We're now seeing hard money loans range anywhere from 5 to 12%. So they're not as verboten, if you will. I don't look at hard money loans with the skull and crossbones that I used to. And it's because they are now becoming a lot more institutionalized and conventional. So if there are opportunities for a business who's gone to their bank and the bank has reduced their line of credit, they need the cash flow, they're looking at it as a bridge situation, maybe they need it for 6 months or a year, whatever it may be. Hard money loans, and typically the name is obviously a negative within itself. It's got a stigma, mm-hmm. but they are typically becoming a lot more competitive. And, I said this to somebody the other day. I was doing a seminar last weekend. If you have a late payment on your credit card to Bank of America or MBNA or any of the large banks that you have credit cards with, if you have one late payment with the bank, you know what your interest rate is today on that credit card?
23.5.
Go up to 28 to 32%.
Oh, wow.
So who's actually doing the hard money loans today?
Yeah, exactly. Your own bank. So, you really think about it that way. You're absolutely right. Yeah, I've seen those, 28, 30%. And that's what typically when you're trying to help.
And the people that could at least pay them off are now being charged, a third of their balance in interest.
Yeah, that's what I was going to say.
It's insane.
Yeah,
and I don't want to get political here, but, the most recent law that just passed, the Frank-Dodd, which hasn't been fully passed yet because it hasn't been fully written, by the way. It's still being written as we speak. Is being written by the banks. The lawyers and the bankers run Washington. They control the policy, and we need the banks and we need the lawyers, and they do a good job. But the fact is that they are feathering their own nests.
I'm not going to
small business owners that we're trying to protect.
I'm not going to jump 100% on that last sentence about needing banks and lawyers, but we'll use it for what it is for right now. But like you're right, though, the banks supposedly lost all this money because of their own doings. They got bailed out, and now they're trying to penny ante us back into existence, and that comes from using your ATM and being charged $1.25 to the interest rates on their credit cards. So we'll move on, though. We've got more to cover here, David, because you also wrote another article called 3 Economic Icebergs, Dead Ahead, where you're taking more of a focused, kind of a concerned eye on small and medium-sized businesses in light of recent elections, which were 2012 elections, federal government elections, the fiscal cliff, which was at the end of last year, which you and I think everybody I know agrees was just kicking the can down the road. We've used that analogy many times. The current sequester and the debt ceiling debates, which we're just going to keep pushing that down the road too, and printing money and whatnot. So you've written an article called 3 Economic Icebergs. The word bubble comes up in here. Tell us a little bit about that article, and we'll break it down.
Well, there are several different areas of that article that I wrote. Thank you for bringing it up. It's a recent one, actually, in the last week. The premise of the article is, again, focused on small businesses, and that business owners have been dealing with, essentially 4.5, 5 years of uncertainty. And whether it's, trying to find out what the ramifications are of policy, whether it's tax policy, whether it's healthcare policy, whether it's regulatory policy. I was interviewed recently on one of the news networks, and I was talking about the fact that we've gone from 400 small business regulations that are EPA-based to, in the last 3 months, or we're in May already, I can't believe this. In the last 5 months, beginning of 2013, we've gone to over 4,400 new business regulations. We had a client that is a small shop. They had a dumpster in their parking lot, and one of the employees did not replace the lid on the dumpster properly. they were fined over $4,000.
Jesus.
This is a small business. And so all of this uncertainty regarding regulatory, healthcare, and tax has really caused businesses to sit on the sidelines awaiting for this gush of a recovery that we've been promised now for 4 or 5 years. And it's affected job growth. It's affected unemployment. Manufacturing indexes are basically down now. You know, we just had a decent employment number that just came out this week. That's before it's revised next month, of course, which is always, you know.
Yeah, but look what happened, David. Look what happened when that came out.
But behind the unemployment reports that came out, we're seeing that manufacturing indexes and the service growth sector has hit 7 months lows. So, you know, a lot of these companies are negative on their outlook. And that was the premise of this article. And then I talked about the different bubbles that I see as the 3 icebergs that you mentioned dead ahead.
Yeah, and David, what I don't get, though, is what you just mentioned is, you know, you've got this jobs growth numbers came out. And in fact, just yesterday, they said 165,000 jobs were added in April, Labor Department, and the unemployment rate fell to 7.5, which we think is yeehaw these days, but it's still way above what is norm, which is about 6.5. Well, at least that's the number that the Fed is looking at before they start raising interest rates, which is another issue we're going to talk about in just a second. So, you know, the Wall Street went crazy. S&P went up to 1,600. The Dow went up to 15,000. You know, I mean, just this little jobs report for 1 month, and everybody goes, hey, let's go. Let's move this economy. So it's very volatile right now, and I can see why small businesses are on the sidelines going, what the heck is going on? But let's get to these 3 icebergs. First one you talk about, is there a bond bubble? Is there?
Yeah, well, a lot of people would agree that there is, and then there's those that will say, no, everything is fine, you know, nothing to look at here, keep moving on.
Yeah.
The interest rates have been reduced and kept at such a low rate by the Federal Reserve that essentially, and I try to simplify this, but what the low interest rates have done is they've essentially enticed a lot of people into making these very risky investments. And, you know, look, there's always going to be somebody holding the bag at the end of the day. There's always going to be somebody that doesn't get the chair at the end of musical chairs. And a lot of people in my colleagues that I work with and people that I speak with who are economists, they didn't predict that Bernanke and the Federal Reserve would keep interest rates as low as he's kept them for as long as he's kept them. Right. We understood that it was necessary, at the very beginning of this Great Recession. But the fact is that what that has done is it's brought in a lot of risky investments into areas like junk bonds. And once interest rates go up, and it isn't really a matter of if, it's when. And I don't know if it's going to be this week, next month, or in a year. They will go up. They will have to go up because of obviously what the Fed is doing by pumping all of this money into the economy. You're going to start to have. And I don't want to get geeky on you here, but you're going to start dealing with currency crisis. You're going to start dealing with threats of massive inflation because when you print money, it devalues the dollar. So when the interest rates do increase, it's going to cause very large numbers of people who just getting into the bond game because everybody's making money in it to absolutely get crushed. And you're talking about, hundreds of billions to trillions of dollars wiped off in value from the economy.
Yeah, and it's interesting you mentioned that too, because the dollar actually did jump against the euro and the yen, also based on those simple employment reports, and I think that's a false jump as well, because we've got so much going on. You mentioned China as well. We'll get I don't think we'll have time for that today, but so there is a bond bubble, it sounds like, and junk bonds are back in vogue.
Yes.
The second bubble you foresee.
And look, one of the things that I say this, in 2008, 2007, 2006, when Wall Street was investing in real estate and they were getting back their 5, 10, 15, 20% returns on an annual basis, the smartest guys in the room, to paraphrase from a movie about Enron, but the smartest guys in the room, these are the guys in Wall Street that graduated Wharton and Harvard business schools, not one of them stood up and said, remember Newton's law? What goes up must come down, right? Mm-hmm. Nobody stood up and said that. There were a few people. Paulson, for example, there were a few people, and they stood to make, billions of dollars. by betting on credit default swaps and so on. But none of these people stood up and said, hey, guys, wait a minute. This can't keep going up. We can't keep having 30, 40, 50% increases a year. It won't work. Well, where's anybody standing right now? There's nobody standing up right now. We've had a 10% increase in real estate in just the last year, and granted, we're still well below 2006 levels, but can you have that kind of appreciation continual?
Well, and that's your second point is there a housing bubble right now? And you and I are in lockstep in that. I mean, I live and breathe it, obviously, on a daily basis. I do believe there is a false bubble going on right now. The investors, and we talked about the top of the program, the investor groups out there, the hedge funds out there, all this cash are buying up single-family houses throughout the nation, certainly in the hardest hit areas like the Inland Empire here, Florida, Texas, Michigan, a lot of different areas in Nevada. They've been picking that stuff up right and left. I'm trying to get nice little families into homes, and I can't do it. Why can't I do it? Because I'm getting beat out in multiple offers, and I'm talking about 8 to 13, 15 offers per property, and this is under $600,000-$700,000 anywhere in Orange County. And I'm getting beat out by all cash 5-day close offers. That cannot last. It will not last. These investors are going to get saturated. They're going to see what's happening. It's going to bring it down. Interest rates are going to go up. It's going to make it more difficult, and it's going to level off. Now, these investors, from what I'm seeing, are on this probably a 5 to 10 year hold time because rent rates are up because people can't buy houses because they can't qualify. So they're buying them, they're renting, they're going to putting 10, 15 grand into them, put a little paint carpet in them. They're putting a renter in there, and then they're going to sell them on, probably, I'm guessing maybe around 7-year time frame. So I agree with you on this housing thing.
I'm deeply concerned about it, and the problem is that it's very geographic. So you're in Orange County, and we do business in Orange County. I know it very well. You're in Orange County, which is one of the nicer areas. It's absolutely beautiful. And real estate is going to be a lot more expensive where you are. Pretty much anywhere within 25 miles of the coastline of California is going to be experiencing that same type of appreciation. The problem is, and it goes back to what you were just talking about before, if these reports that the White House are now basically saying to banks, "Hey, look, lower the requirements for a mortgage." What banks are going to start doing? You're going to start to have some more aggressive banks. They're going to start to do some of what was considered subprime not more than 6 years ago. They're going to start doing these again, and that's going to set off a flurry of competitors within other banks. And I think that's where you start to have this cataclysm that could be affecting the economy as a whole as well. But beyond that, one of the things that I mentioned in the article is that for about 3 to 4 years, we saw a really good trend, and that was household debt was decreasing.
Right.
Everybody was paying off their loans. They weren't going out and spending. They weren't taking the interest-only free loans for furniture or cars or anything like this because they just wanted to pay off what they owed. And that was a good thing. I don't believe debt is a good thing. It's a fairly recent phenomenon in our society. It's 40 years old. My parents' generation, they grew up believing if you can't afford it, you don't get it. If you can't pay for it, you don't get it. And so, we from the 1970s on, our generation, Troy, would basically have been trained as consumers to basically say, if you can't afford it, finance it. Well, a lot of people were doing that for many years, and for the past several years, they've been paring down that debt until now.
Yeah, and you're saying
what is deeply concerning to me is that household debt increased in the last quarter, fourth quarter of 2012, by almost 6.5%.
Yeah, which is a substantial number.
It's huge.
Yeah. And then you've got the trifecta of the Titanic target, and that's called the stock market bubble. What do you see in the stock market as far as a bubble is concerned?
Look, let me just say this. I'm not a stock market investor. I'm not shorting stocks. I don't want the stock market to go up. I don't want it to go down. I'm an observer of what is happening in the stock market. And as you mentioned, we touched upon 15,000 yesterday for the first time ever. Listen, and I say this with friends who are wealth managers, who are stockbrokers, who work at the banks that are selling these products. So I say this with all respect to my friends that are in the industry. This is a phantom market. It is based upon nothing more than the result of quantitative easing, which is the Federal Reserve printing money, spending that money on financial securities from the largest Wall Street financial firms. Those firms are sitting on a lot of cash. They've cut back their expenses. They've cut their payroll. And so their profit margins look good, and they look good on paper. These banks are looking pretty good on paper. And remember, the Dow composite is 30 stocks, right? It's your Microsoft.
Right.
It's your Bank of America. And so it isn't representative of the entire economy. So when you see this type of massive growth, over 100% growth in the past 4 or 5 years in the stock market, it's been based upon the quantitative easing, the stimulus spending that has been essentially floating these companies, and they look really good on paper.
And the Fed, by the way, is spending about $85 billion per month in bond purchases right now, which is what you're talking about.
Yeah, and Bernanke just confirmed this week, the Fed chairman just came out this week and confirmed that his committee have committed to continuing this, basically for another $1 trillion.
Wow.
And this is technically it's the fourth round. It's the third quantitative easing round, which is what this is. It's printing money. Mm-hmm. You know, look, can you imagine, Troy, you owe your mortgage. Let's say you need to come up with $2,000 or whatever it is. You go into your garage and you hit a button on a printing press, you print $2,000 and you send that to the bank, right?
Yeah.
Well, that's what the Federal Reserve is doing. So where is all of this money coming from? And the net result, and this is my concern, is that with all of this money that we have printed and spent, with all of this massive debt that we have accumulated, we've got 2% GDP.
Yeah. Yeah.
Could you imagine if we weren't printing this money what the GDP would be today?
Oh, it would be unsustainable, ridiculous.
So that is my concern, and I think, look, I was invested very heavily in my firm Valcor. We had a dot-com subsidiary in the financial services sector from 1998 to 2000. I remember in 2000, in the heady days of the dot-com boom, there was an article that came out in Barron's. It was March of 2000, and it basically said, there's no there. Right? Mm-hmm. Regarding, billion-dollar valuations for a messenger company, or a billion-dollar valuation for, a company that doesn't do anything, and it's all online. And this Barron's article came out, and everybody woke up, and it was like, oh, my goodness. And then we had the dot-com crash that week. I think that you could have a similar situation that could occur, whether it's this week or next year. It will occur when somebody wakes up and says, hold on a minute. There's absolutely no there.
And that could absolutely cripple what we have as what is a recovering economy right now. It could absolutely just take the legs right out from underneath us.
Well, that's why I call it an iceberg dead ahead.
Yeah, exactly. And David Sussman, you founder and CEO of Valcor, the people who are listening, there's all these articles and great information on David's website. It's Valcor Worldwide. That's VALCOR worldwide.com. The articles we're referencing today are on his website. There's a lot of great information there. And you're obviously well-rounded and informed to help these businesses. As we wrap up here in the last couple of minutes, David, give me an idea of who should be coming to you? What small or medium-sized businesses, at what point do they go, we need help? Because you got to know that, really what a lot of these folks are doing with these businesses, if they get in trouble, they're kind of sending out a DNR order, do not resuscitate my baby. And that's just got to be the most difficult thing to do. So when should people come to you? Why should they come to you?
Well, typically any business owner that is finding short cash flow situations that's affecting that point, it's a detriment to their business. It's affecting the business in such a way in which it's having a detrimental impact. Some of our clients have gotten to the point where they have creditors corresponding with them to the point where they're threatening litigation, or maybe they've even about to proceed to litigation. And we don't take business away from attorneys. We provide an alternative resolution, and we work with a lot of very, very good attorneys. But essentially, there's the side of the cash flow, which has caused the business to come to a standstill. We can come in and restructure the debt, and also cash flow to the point where we can bring in liquidity for a company. And a lot of business owners that I speak to today tell me, hey, look, I went to my bank. They're not going to give me a business loan. There's nothing you guys can do. Why would I even call you? We, as I mentioned to you earlier in the discussion, we have access to over 300 categorized lenders that we work with, specialist companies that in many cases will take a look at a business situation and we can find options. And the key is to get that lifeblood of that business, cash, moving again. Once the business owner, and look, business owners, they're psychologically, they're frozen.
Yeah.
They're dealing with the stress and everything else. We come in, we basically tell them, get back to doing business. We're going to handle this for you, and we get them back on track.
David Sussman, thank you so much for joining me on the Money Matters program today. That is David Sussman with Valcor. You can look him up at valcorworldwide.com. That's VALCOR worldwide.com. David, thank you so much.
Thanks, Joy. Appreciate the time.
You're very welcome.